Hi, everybody, and welcome back to Chapter 11, video number 2. And when we left off, we were looking at issuing no par value stock. And here, if it doesn't have a par value, we don't need to worry about it. All we do is we put the entire amount into common stock, which is shown easily in this transaction. Dylan issues 1,000 shares of no par value common stock for $40 a share. 1,000 shares times $40 is $40,000. So we receive cash of $40,000 and we issue common stock no par value for $40,000. And that's all there is to that one. Stated value, we do that very similarly to the way we do par value. So here we issue 1,000 shares at $40, but we actually received $50 a share. So the cash we receive is going to be $50,000. Again, we would take common stock at the stated value for $40,000, and then we had paid in capital in excess of stated value common stock for $10,000. Pretty straightforward. And then sometimes, very rarely, in my experience, we might purchase something with stock. And in this case, we issue 4,000 shares at $20 par value for is given for land, which is valued at $105,000. So we're going to value that land here at $105,000. At $20 par value times 4,000 shares, we get $80,000. So the difference is $25,000, which is the paid in capital in excess of par common stock again for that transaction. But instead of cash, it's going to be land. Okay, so we often have, this is a new general ledger account for you guys called organization expenses. And these are the costs of issuing stock. We don't just send it out on our own recognizance. We usually go through a third party, in my experience, New York-based companies do this for us. And we pay them a fee for that service. And sometimes we pay for that in stock. So in this case, we had 600 shares at $15 par value for $12,000. And so our organization expenses were $12,000. At par value, $15 times 600 shares, we get $9,000 of par value, and then that difference of $3,000 is paid in capital in excess of par common stock for that journal entry. Pretty straightforward, I think. Okay, let's take a look at transactions involving cash dividends, stock dividends, and stock splits. So if we're going to pay a cash dividend, that's the most common thing you'll see. All that means is the corporation is going to give a small amount of money to every stockholder in proportion to the number of shares that the stockholders have. So normally, let's say they pay $1 a share. When you have 10 shares, you'll get $10 worth of dividends. You don't have to pay that as a corporation. I think you'll find that the corporations that do pay dividends are the corporations that are mature, not growing, a lot. Whereas the high-flying tech companies that are brand new, they may not pay dividends and plow that money back into the corporation. So just so you know. But you do have to have a couple of things. One, you have to have sufficient balance in your retained earnings to pay that dividend. And of course, you have to have the cash necessary to pay that dividend. So let's see what that is. We have 3 important dates related to cash dividends. We declare it, we record it, and we pay it. Now, when we declare it, we right then and there record the liability for that dividend, right? And then on the date of record, that means we figure out who's going to get those dividends. And there's no entry required for that. We just do, that's an administrative task. And then once we've determined who's going to get it, eventually we do pay it. And when we pay it, we record that payment of cash to stockholders. So let's see how that works in the way of journal entries. Here, on the date of declaration again, that's when we're going to recognize the liability. So on January 9th, they declare $1 per share cash dividend on $5,000 common shares outstanding, right? We're not going to pay dividends on treasury stock. The dividend is going to be paid on February 1, but on January 22nd, we're going to figure out who's going to get the dividends. Again, we're not going to have a journal entry for January 22nd. So what we do is we debit retained earnings in this example and credit common dividends payable as a liability on the balance sheet. Sometimes we debit dividends, and then at the end of the month we close those dividends to retained earnings. But eventually it gets to retained earnings one way or the other. And that's what we do. Okay, so now we've declared it and we've reflected those dividends in the retained earnings. Now, when we actually pay that, we're going to make that liability go away for $5,000 and credit cash to pay that dividend. Pretty straightforward. Stock dividends are an interesting occurrence from time to time. All we're doing here is we're issuing some shares to our existing stockholder base. And why would we want to do that? You know, the more shares you have outstanding, the lower your stock price is going to be. So you want to keep the price of your stock affordable. So we issue some stock, it dilutes the earnings per share, and it also reduces the price per share. There is no value per se in a stock dividend. It's good to remember that when you're doing these journal entries. But we have two kinds of stock dividends. One, we have a small stock dividend and a large stock dividend. And oddly enough, we do the journal entries differently. So it's important to know how to do that for both the small and the large stock dividend. Here, Quest has 10,000 shares of $1 par value stock outstanding, and they declare a 10% stock dividend. So that's going to be 1,000 shares. When the stock was selling for $15 a share, that's our market price, the stock will be distributed to the stockholders on January 20th. So let's see how that looks and how those are a little bit different. So what we do is we take the market price of $15 a share and multiply it times the 1,000 shares of stock dividends. And that means that I'm going to reduce basically retained earnings with a debit of $15,000. The common stock dividend, note the term distributable here. It's not common stock, is not a payable, it's a distributable. And then we have paid in capital in excess of par on common stock for $5,000. So that has the effect of, I think you can see. And then what we do when we actually distribute that is we're going to then get rid of this common stock dividends distributable here and credit common stock $10 par value for that 10,000 shares. So I think you can see that pretty easily. This kind of walks you through how the stockholders' equity behaves under those certain circumstances. And here you can see in total, my total stockholders' equity doesn't change, as it should not. But here our common stock goes up by $10,000 on the date of payment, and then the paid-in capital also goes up by $5,000. So, but retained earnings falls by $15,000. And so the difference is nothing, you know, $143,000. Okay. Next, Quest has, this is a large stock dividend now. We're doing it a little bit differently. Here, we don't use market value. Here we have 10,000 shares of $1 par value. And on December 31st, Quest declares this 30% stock dividend. The stock is going to be distributed on January 20th. So what we do is we figure out how many shares, and that's going to be 30% of 10,000 shares here. And that's 3,000 shares. And the par value is, well, they have a little typo here. That should have been $1 a share, not $10 a share par value. And so the 3,000 times 10 is going to be 30,000. And that's going to be our common stock distributable. This should have been $10 par value. Okay, so that is all we do when we declare our 30% stock dividends, because it's greater than the 25% threshold for large stock dividends. So, stock splits, same kind of principle here. Here, all we're doing is we're going to split basically our old shares. We had 100,000 shares and it had a $20 par value. New shares, we're going to generate another 100,000 shares and drop the par value to $10. So that's an easy one to do from the standpoint of journal entries. So as we look at the effects of this, the cash dividend does decrease assets, cash in this case. It does decrease stockholders' equity because retained earnings is decreased. Small stock dividends in total have no effect. Large stock dividends in total have no effect, and stock splits have no effect. But the small stock dividend will increase common stock, as will the large stock dividend. And the small stock dividend will increase the paid-in capital in excess of par, whereas the large stock dividend will not. So a nice little summary chart here as to what's going on with the different kinds of dividends and stock split. Okay, the characteristic of and distribute dividends between common and preferred stock. This looks like a good place for us to stop this video. And when we return, we'll take a look at issuing preferred stock. Until then, bye for now.